Hello all, welcome to Universal Group of Institutions, Bangalore. Today we are going to discuss an important and a very simple topic, that is, what is the difference that exists between bonds and debentures? What is the usage of bonds? What is the usage of debentures? What is the identical features that exist between them, and what are the differences that exist? That is, bonds and the debentures. Before we understand this, the difference between these, we need to understand a simple example taking about it. Let's say an individual who requires 1 crore rupee to start a company, whereas this individual is having only, let's say, 20 lakh. So he is in need of another 80 lakh. So what are the ways in which he can get this 80 lakh? Maybe he can approach his family and friends. Maybe he can approach a bank. If he approaches a bank, whenever he visits a bank and asks for a loan, yes, bank may agree to lend him a loan, but instead, the bank expects something as collateral from the individual. So based on the collateral, the nature of the collateral, the bank will lend money to the individual, and where an individual has to pay the interest on an annual basis, and after a certain period of a time, the principal amount needs to be paid back. This is the way in which a transaction that happens between an individual and a bank. Similarly, an individual can also raise this 80 lakh using the method of a equity, that is by issuing shares. Let's say the each share is worth of a 1 lakh. In that case, he needs to issue 80 shares. So, but the best thing about issuing these shares is that whenever a company makes a profit, then only this individual needs to share this profit, because they are shareholders. They are going to share both profit as well as the loss. In case when an individual gets a money from the bank, regardless or irrespective of the profit and a loss, the individual has to pay the interest on an annual basis. This is the method of the equity, or else the company can issue even the bonds as well. Then what exactly the bonds? Let us look at the bond is nothing but a piece of, it's an agreement. The agreement that is between the bond issuer and the bond borrower, or the lender and the creditor. Now let's say this individual or a company that who has issued the bond, okay, and this is X and Y has agreed to buy this bond. This is a piece of agreement. So what is this piece of agreement that is going to consist of? Piece of agreement says that, let's say this bond is worth of a 10,000 rupees. Now the principal amount that is involved here is the 10,000 rupees, where the X has agreed to pay him, let's say, an interest of 7% on an annual basis for 5 years. After 5 years, the 10,000 rupee will be returned to the buyer. So this is about the bond. Bond is nothing but a very simple piece of paper. It's an agreement between the lender and the creditor, where an individual who has borrowed the bond, whom we call as the bondholder, in case in our example it is a Y is going to receive an interest or a coupon, which we call it as 7%. After 5 years, this individual is going to get back his principal amount. Now, before a company issues the bond has to be backed by any asset. Bond has to be backed by any asset. So, in case of a failure or in case of a loss at the company, the bondholder will get his money by auctioning or by selling this asset. So remember very clearly, bonds are backed by assets. Bonds are backed by assets. Whereas the debentures are unsecured. Debentures are unsecured. They are not backed by any assets. So then why do still people buy these debentures? The debentures are being brought by the people based on the credit worthiness of the authority or a company that is issuing these debentures. Since debentures are not backed by any assets, debentures are more risky. Since they are risky, they are going to offer a higher interest rate in comparison with these traditional bonds. So remember, the exists a very simple difference. The simple difference that exists is the bonds are backed by assets. Bonds are also going to pay the interest. And they have a maturity period, whereas the debentures are not backed by any assets. Since debentures are not backed by any assets, they happens to be very risky. Since they are risky, more risk, the higher will be the reward. So they are going to offer a higher interest rate in comparison with the bonds. So remember very clearly, all debentures happens to be the bonds, and not all bonds are the debentures. All debentures happens to be the bonds. So this is a simple difference that exists between the bonds and debentures. So ideally, according to the CRISIL, that is the credit rating agency, debentures which are rated above AA are considered as the safe investment. And in case the, let's say, this company get bankrupt and the company is being liquidated, the bondholders will have a first right over the assets. Then only the debentures can have a right. So remember this simple difference that exists between the bonds and debentures. Bonds are secured, debentures are non-secured. All debentures happens to be the bonds and not the otherwise. So that's it from our end. Thank you. Keep watching our channel and subscribe. Thank you.